Hey, welcome and thanks for tuning in. Very excited to share a new investment opportunity with you. In fact, this is one of two that I currently have in escrow in Greater Phoenix shopping centers. They look a lot like the last couple projects that I've done, but as the saying goes, if it's not broke, don't fix it. So let's dive into the deal. It is in Mesa, just a few miles from the shopping center that we bought back in December, with a lot of similar characteristics. And the things that I love to see, it's a building that is grossly underperforming everything else in the area, predominantly because of the current ownership. Very wealthy guy who owns a lot of buildings free and clear. He's doing million square foot warehouse deals with Amazon now. And so this little $1.5 million deal is kind of a rounding error for him. And I'll show you some of the things that I think we can go in, adjust, and significantly increase the value of the building. So 706 West Southern in Mesa. It's affectionately known as the Honey Baked deal at this point because that tenant has been in there for nearly 30 years. It's only 15 minutes from the airport, so I love that I can get there quickly. Anybody who invests in this deal and wants to visit could also get there very quickly. And again, the economies of scale with having it right next to two of my other properties in the area just is leading to some synergies with, tenant referrals from one building to another, property management synergies, vendor synergies. My lender is liking all of these deals. So there's a lot of things that I love about that. Okay, so a couple of things that are really noteworthy right out of the gate is the main intersections that were in between. Country Club Drive here on the right gets about 40,000 cars a day. Alma School Road gets nearly the same. Two very, very prominent, grade A corners. You're going to see McDonald's there. You're going to see Starbucks there. The who's who of tenants will locate on Southern and those two intersections. We are a mid-block shopping center here, highlighted by that circle and the blue dot, which means we're going to expect to see, a notch or two down from Starbucks and McDonald's. I think it's going to be good mom and pops. The fact that Honey Baked is there is a really good sign. It's also exciting to see a brand new, 300, 400, 500 unit apartment complex that was built right kitty corner across the street. There's a gorgeous new office tower down at the other corner here. And it's a part of town that the city really wants to see get revitalized and reinvigorated. So we're doing what the jurisdictions want to see happen in here and revitalize and really make this shopping center shine like it once did. So here she is, just over 20,000 feet, under contract to purchase for $1.55 million. Yes, you're reading that right. That is only $67 a foot, which is amazing. I haven't seen a shopping center of this location quality trade for this price per foot in a long time. And I look at a lot of deals just like this one. So that is substantially below replacement cost. To build something like this today would be well over $200 a foot, maybe more than that now when you think about the rising cost of construction, both materials and labor, not including the lease-up commission, the tenant improvement allowances that are available. So to have that kind of cost basis just gives us a huge competitive advantage versus other properties in that area. We can undercut the rent, we can offer leasing incentives and do things to get this high vacant building filled up and back to its former glory. Why is that possible? For a few reasons. It's an off-market deal. And I've been in pursuit of this deal since about November 2020. I was in negotiations with the guy trying to secure seller financing and he just wouldn't go for it. But I found a bank loan that's very, very favorable that's going to make this deal a no-brainer and a slam dunk. So I'm moving forward with it without seller financing. Months later, we're kind of back to the tables. So that's really nice because we're not in a bidding war with anyone else. He agreed to the price verbally on the phone with me. We wrote it up that next day, and we're just chugging right along. So one of the most important things when we're looking at any shopping center is the car count. This is what all the major retailers in the world look at because that drives how much foot traffic is going to be coming into the building. And when I see 30,000 cars a day, that means just about any retailer would consider locating there. I think closest to us is a Sonic drive-in, and then there's many name brand tenants down those roads as you reach those intersections. I don't think we're going to have a national credit tenant here, but more of the mom and pops. And I'll show you in a moment who I think is going to backfill this building with us. In terms of the characteristics, it's not Scottsdale, it's Mesa, but it's a decent area. I see median household income here of about $40,000. And so that means you would have a tenant like a Boost Mobile or a Cricket, or all sorts of food and beverage and fitness, dog groomers, nail salons. They're going to be the go-to tenants, barbershops in a place like this. You see tremendous rooftop density. The population here is just insane. There is a lot of people. There is a lot of projected growth in this part of town. There's a lot of people who eat lunch there at the restaurants. So it's good. It's good to see that. That's along with visibility and car count, good rooftop density. Those are some of the essentials that you want to have to see a high vacancy shopping center get filled up in short order. Okay, so here's a list of likely tenants that I think are going to go in here. The hottest category by far right now across all of Phoenix is food or beverage or dessert. I think fitness and gyms would come in a close second. And then all of your service-centric daily needs tenants that are, very internet or Amazon resistant. These should look familiar if you've looked at some of my past deals. Nail salons, barbershops, hair salons, massage, insurance, tax prep, groomers, dance studios, maybe a smoke shop, martial arts, mailboxes, etc., or a print shop. We've done preschool deals. We've done dance shop deals. These folks are looking for space consistently and are reopening over and over again. All right, so let's look at some of the characteristics of this building. It is so when you look at it today from a curb appeal standpoint. I think one of the first things that we're going to do upon closing is order a new slurry seal and stripe of the parking lot. It's not horrible structurally, it looks pretty good, but that top coat is really going to make it pop. We'll probably also hit the entire exterior of the building with a fresh coat of paint, which will match the new monument sign that's coming in as well. Back to that monument sign in a moment. When you're looking at the aerial view of this building, there's a few things that I love about it, even more than the last deal that I bought. And it's that we have the ability to drive around the back side of this building. There's a curb cut right here. There's another one right here. There's a monument sign right here. And there's another monument sign that's kind of buried by that tree. This is kind of exciting because cars could come in through that first curb cut, drive around the back. You can kind of see the tracks here. There's actually a potential to put in a drive-through here. I got to do some more work with an architect to see what that's going to take. But maybe just do a pop out here. Drive-throughs are by far the hottest commodity in Greater Phoenix right now. Everyone wants one. Every retailer wants one. Starbucks doesn't open a facility right now unless they have a drive-through. And so those can command top dollar rents and fly off the shelf. If we could get that done here, that would be a huge bonus. And that's not included in any of my numbers or underwriting here. So that would be fun. If not, that could end up being a nice little patio for a food user, or if a CrossFit gym takes it, kind of the outdoor facility that you've probably seen them use a lot. So all those things are nice to have benefits. Additionally, I get a lot of inquiries now from tenants who are looking for rear access. So someone like a window tinting shop wants to be able to pull a car in the back or have a roll-up door. Or we got an inquiry from a catering company and they want to have rear access to load the food in and out of. Or a furniture store wants to have rear access so they can load stuff in and out with double or fully wide doors. So that's a nice perk to have. Not every building has enough space behind it to be able to get that rear access. So good perk there. One of the major opportunities here is going to be putting a beautiful new monument sign in. We just completed this down the road at the Gilbert Square deal. So I believe the city of Mesa is going to allow us to go 12 feet tall with a lot more panels, better visibility. This thing looks tired, so it just doesn't have the curb appeal that we want to project on that road with over 30,000 cars a day. So that's the first order of business. That's about a $20,000 investment, but one of the best things that we can do to attract tenants to come to the center and have their logos and brands prominently displayed, not just on the building, but on that monument sign, or possibly 2 monument signs if the city will allow it. All right, another issue with this center is that it just does not show well. The poor leasing agent, Hort, it just has an almost impossible task. I mean, you can see how this property is kept right now. You've got ceiling panels coming down. It's being used as a storage unit. The power is not on. I mean, you got to walk through there with a flashlight and protection, because you just don't know what's going on in here. So our plan would be to go through and do a white box of the space. We'll take down all that destroyed ceiling tile, probably do an open floor concept. We'll clear out all that debris. We'll make it a blank, clean slate, so anybody that's touring could walk through there and visualize their business locating in this space. This particular suite is pretty huge. We might end up demising that into a smaller floor plan. And we can jump back into the floor plans and show you what that looks like, because there's a couple different configurations. Probably end up being between 6 and 10 tenants. We'll see how that all shakes out and the size of suites that are in demand by tenants as they reach out. Another example of the suites, it looks a little bit scary. To me, it seems like someone got halfway through a build out here and, for whatever reason that didn't complete. But there's some things that we can do. In the back of this picture, there is a bathroom that's halfway built out. We could probably finish that bathroom. Almost any user is going to leave that bathroom where it's at and then kind of build around that and not have to mess with that plumbing. Other suites show a little bit better. You can see, this one was built out as an office space before. This is one of the more turnkey suites that's available. I think, again, there's some things that we can do to get the power on, get a nice bathroom, toilet, vanity, sink in there, ready to go, so that someone could get their business open as quickly as possible. That really seems to be a hot button with tenants right now as they're touring out of their spaces. Hey, how quickly could I get open, and how much is it going to cost me to get this space to a point where I can have customers in my suite tomorrow? Okay, let's look at some of the rental lease comparables in the area. I've underwritten this deal assuming we'll get $12 rents. There are many comps nearby that suggest that we could exceed $15 or $16 or $17 in some cases. I'm going to be very conservative with those numbers. If we exceed $12, great. All the numbers look even better than what I'm about to show you. But I think that gives me confidence that we could meet or beat that $12 mark, or be the best value in the area where, we're offering a good suite with good tenant improvement allowance at a good rental rate with good terms. And that's more appealing than the shopping center down the street. We're more responsive than those other landlords. We've got better leasing agents. We've got better marketing, you name it. Okay, so let's dive into the numbers. Follow along with me here so I can break this down, and this should be pretty straightforward. So we're buying the center for $1.5 million, and there's a little bit of income today at 60% vacancy. And I don't even know if this 1001 Nights restaurant is going to survive, so it could change a little bit from here, but we're starting out with about $55,000 a year in net operating income, which makes us just barely cash flow positive on our nice, relatively low debt service or our mortgage payment. That is a function of getting a 65% leverage loan, which is right here, about $1 million from First Bank, a local lender in Phoenix who likes me, who likes this deal and the other deal that I'm under contract on. So what they're offering me is basically a bridge loan program that's 4.2% interest only for between 12 and 24 months. We're finalizing those terms, but then they would like to take the loan to a permanent loan and have it fully amortizing after that. That's what you see over here in the refinance column. More to come on that in a second. So here's how it shakes out. We're actually going to pay the leasing broker's commission out of pocket to buy this, and then we'll have an acquisition point that pays to cover some of my overhead, some legal costs, and then I've allocated $400,000 for tenant improvement allowance. That's about $10 a foot to help tenants build out their suites. It's another $80,000 in commission. That's allowance for replacing some of the older HVAC units on the roof, for doing the parking lot, for doing the monument sign, for doing the paint, getting it looking good. Maybe we'll come in a little bit lower than that, but again, I like to be conservative and pad my numbers a little bit so we have some good allowances, and you can see reserves in there. Brings our total basis of the building to just under $2 million. That's that 1.97 number there, which means the total down payment for the deal will be about $975K, or that's the total raise. That's the amount that's available to friends and family to contribute towards the deal and have an ownership stake in the project. All right, so then let's go through the fun part as we start to lease up the building to 50% to 75% leased and then fully leased. You see the net operating income and the cash flow numbers start to jump up to 80 grand a year, to 150 grand a year, to eventually, when we're fully occupied, around 230,000 in free cash flow. And then what I've projected here as well is as you fill up the building, the value increases right along with it to what I think is going to be somewhere in the mid to high threes in terms of the value. So buy it for 1.5, put $400,000 to $500,000 into it, and then it's getting appraised for $3.6 to $3.7 million. So I love to see that almost 50% upside potential on a deal. It means there's a lot of cushion there. If we, don't get all those rents, if it costs a little bit more in renovations, if it takes a little bit longer to lease, there's still so much profit and meat on the bone that we're going to do very well on the deal. And there's some cushion in there for the who knows what's that might happen. Okay, so in this scenario, there's basically two exits for us. We either sell the building like I've done in the past a couple times for a nice profit, or refinance and hold, which I'd like to do more and more of. So I think assume that's going to be our most likely scenario is refinance and hold this deal for years to come so we can continue to build more cash flow and more wealth and get to the point where we've all got multiple commercial properties in our portfolio. What that looks like here is the appraisal coming in at 3.6 million. If we do that, we should be able to pull some cash out of the deal. In this case, I've modeled a 50% loan to value loan from the bank. So it appraises for 3.6. Mr. and Mrs. Banker, we're only going to pull out 50% leverage. I couldn't think of a more conservative loan than that. That would be a $1.8 million new loan or permanent loan on the property, which would mean we can return a lot of capital to our ownership group who put in that initial $975,000 down. Here we're looking at a scenario where we could get 750 of that back. What's amazing about the refinance is that is not a sale. It is not capital gains. It is not taxable. So that the majority of the money that we have in the deal comes back to us while we still maintain ownership. We've still got cash flow. We've still got loan pay down. We've still got appreciation. We've still got tax advantages coming in. I love that scenario. On the next slide, I'll show you what that looks like for an individual owner. As a backup plan, on the sale side, if we sold that for $3.6 million, we would pay off the $1 million loan. We would have commission. We would have some closing costs. So we would have distributable proceeds of around $3.4 million. We would pay back the initial equity that investors have in the deal, the $1.38 million. And so we'll look at the next slide, what that actually looks like for each individual investor. So kind of carrying those numbers down. Here's what it looks like for someone who has invested $100,000 in this deal. Not a lot of cash flow during the lease up. That's not a surprise. So basically assume no distributions for the first 12 months of ownership. But as we start to get fully leased, there's a lot more free cash flow to go around. But that's not why we're interested in this. We're excited because of the huge pop in value when we do that full stabilization that we can realize with the refinance or the sale. Here's what that looks like for an individual. If we can pull out 50% leverage, and it could be more than that, this scenario would mean the $100,000 that was initially invested, about $77,000 of that could get returned to that investor, which means they're leaving about $23,000 in the deal. On that $23K, they've got just over $5,000 a year in cash flow that would come out of that. That ends up being about a 23% cash on cash return. That's not counting tax advantages. That's not counting the continued loan pay down that we're going to realize. And that's not counting the rent bumps that are baked into all these commercial leases. So every year that cash flow continues to creep up as our loan payment stays constant. Well, that loan payment here would lock in around $114,000. So why do I love this? Because now everybody who's invested in this deal continues to own their proportional share of it. They continue to get cash flow, and we can turn around and, if you want, put that $77,000 back in your bank account or invest in the next deal that comes along, continue to do this over and over and over again. I love this model because you don't have to have $1 million to continue to buy more and more and more real estate. You can get in with a decent six-figure investment. On the sales side, here's what that might look like. If we take these profits and we split them up proportionally with what that investment owns, that person would have a $50,000 profit share of this property. And just to show you, that's a 3.6% stake in the deal for $100,000. So what would that look like? They get their full $100,000 back plus an extra $49,000. So about a 1.5 equity multiple. You're probably wondering, how long does it take for that to happen? That's the $1 million question, literally, right? The deal before this one took 14 months to turn around and sell from start to finish. So when you look at that on an annualized return, it's staggering. If it took 2 years, it would be about half of that. 3 years, you can do the math and do that annualized return there. So I want to do it as quickly as I possibly can. It's why I spend so much time and energy working on my leasing to fill that property up, to jack the value, to be able to do the refinance or sell, because the cash on cash return gets that much more compelling. So that's what the numbers look like. I should reiterate what it says right there at the bottom of this slide, that all of this is a projection. None of us have a crystal ball. Could it happen a lot faster than the last deal? Maybe. I think I continue to get better at this as we do it. We have more relationships in town with more leasing brokers, but it also could take a little bit longer. And some of these costs or numbers could be a little bit off. But I try and be very, very conservative with my numbers. Personally, we haven't found anything that we like investing in more than this. When I think back to all the rentals or the other things that I've invested in, this far exceeds what we've been able to realize. So I love that risk to reward profile. Like I've done with the last few deals, this is a first come, first serve opportunity. There isn't that big of an equity raise, so I think it'll go fast. In fact, I've got $250,000 that's been committed already from an existing partner. We have until August 13th to complete our due diligence. I don't really see anything that's going to derail this deal from closing. We just are getting it at such a great cost basis in such a good corridor. I think we'd be crazy not to buy it. It will close within 15 days following that. So right before the end of the month, I would expect that we have all of the wires in from our partners well before then, the loan funded, and maybe even be in a position to close early, especially if we've got some of these prospective tenants that are circling, ready to sign leases. We want to do that the moment that they're ready to go. So if you're interested in the deal, go ahead and reach out to me via text, via a phone call, via an email, whatever it is that's your preferred vehicle. Let me know, hey, I'm interested in doing this. I'd like to place $100,000 or $200,000. If you're going to be doing it through your cash, through your 401k or your self-directed IRA, your retirement accounts, if you've got any follow-up questions about how to do that or any of the specifics of this deal, I'd be happy to answer those individually. And then for those of you who don't know, there's a few appendices slides on here about why I love Phoenix. I mean, it's just continuing to explode as it has for the last few years. There's a lot of reasons why people are moving there, why companies are moving there, why the job growth continues to fuel so many things. There's a little segment here from CoStar on how Phoenix did through the pandemic and how it's recovering. And some categories are actually doing better than ever. Think about your drive-through restaurants, for example. And then just some of the characteristics of Phoenix. Look, we can go across the state line versus Southern California and get, in many cases, double the cash-on-cash returns that you could doing, let's say, an apartment deal in Southern California. So I like being in the path of progress. I like being in a growth market. I like being in a landlord-friendly state where if a tenant doesn't pay, we can lock them out the next day, no questions asked. With commercial real estate, that's just how it works. So thank you for tuning in. Thank you for your interest. Look forward to hearing from you soon. And then be on the lookout for the other deal that's coming up. This is a hard corner in Tempe on a very, very busy intersection, very nice part of town. So similarly exciting deal with substantial upside, little different profile. That's called 910 Elliott. And so maybe we can link to that or have that other video queued up here right alongside this one. Take care. Talk to you soon.